Okay, so the preceding discussion actually motivates us to take another look at a topic that we had seen before earlier in the course. So this is the capital asset pricing model, which is often written as CAPM for short. So remember that we had discussed this when discussing decision making under uncertainty as well as portfolio choice. And basically what CAPM does is it provides a prediction regarding expected returns on risky assets. Now, why do we care about these particular items? Well, if you want to answer the following set of questions, this is something that we cannot avoid. So, for instance, if we want to think about how high would be the expected return forecasted for a stock compared to the risk associated with the stock, right? So, here again, we want to link expected return to the risk. So, in order to answer this, CAPM can provide one answer. Then how do you kind of like price an initial public offering of a stock, right? So this is something that you have to kind of like think about modeling, because this is not something on which you are going to have past data exactly, right? Because you have not yet offered this stock. So you want to think about comparable stocks and so on, right? So again, CAPM can be a useful thing. Again, how will a new investment project influence the return that the investors want on a company stock? To answer this kind of questions, again, CAPM is useful. So what's the central conclusion of this model? Well, that's going to basically state that the risk premium associated with a project or a asset should be proportional to the exposure to systematic risk, and it should not depend on a firm specific risk, right? So this is again some idea that we have already been kind of like hinting at, but we'll see that CAPM actually provides a more precise way of showing that this is the case. So we are going to have this discussion on CAPM in two parts. In the first part, we are going to start out recapping this formula that you have seen before, and seeing what are the ways in which one can use it. And in the second part of the discussion, we'll think a bit more about what are the assumptions, or what are the one set of assumptions that can actually lead to this formula, right? So that is a more deeper look, and we'll postpone that till we have understood a bit more about how to use this formula. So, as mentioned, CAPM basically gives a formula for the expected rate of return for a project, and it gives it as a function of several inputs. So, you require the risk-free rate of return, you require the expected rate of return on the market portfolio, and you also require the project's market beta. If you have these inputs, then the CAPM formula states that the expected return of the project is equal to the risk-free rate plus beta I. So beta is the market beta that we have been talking about, multiplied by expectation of RM minus RF. So expectation of RM is the expected return of the market portfolio, and RF again is the risk free rate. So this term expectation of RM minus RF is also known as the equity premium, right? So the excess return that the stock market is expected to get on average over the risk free rate. So this is the formula, and you need to memorize this formula because this actually will come up quite often in our discussion. Okay, so what are the implications of this formula? So notice that it basically states that an investment's cost of capital is going to be lower when it offers better diversification benefits for investors who hold overall market portfolio. And as we have discussed, this market beta is a measure of how much an individual asset or a project contributes to the overall portfolio risk. And so therefore projects with higher beta, so projects who actually move more in line with how the stock market moves, that those are the ones that would require higher expected rates of return, whereas the projects with lower beta, so those who move perhaps against the stock market movement, they actually provide benefits in terms of risk reduction of the portfolio, and so therefore they would require lower expected rates of return, right? So we can see from this thing here as well. As you would expect that this equity premium is going to be something positive. So therefore, higher the value of beta I, higher is the expected rate of return that would be required from the project, right? So we can see that from here. Okay. One thing to note is that nowhere in the formula did we actually use the standard deviation of the project, right? So the risk or the contribution to the risk is actually being captured in terms of this beta I, right? You do not see any sigma square and so on, right? When we are thinking about, okay, what would be the expected return as a function of the different risk factors that are relevant here, right? So it seems that standard deviation of the individual project itself should not actually affect this expected rate of return, right? Okay, so what that implication is that the investors do not care about the project's variance, since basically they can diversify idiosyncratic risk or the particular risk associated with the project's variance, right? Uh, what they care about is this market beta term, though, right? And this beta I, for instance, is basically capturing how much do the rates of return move with respect to the stock market movements, right? So that actually captures the component of risk that cannot be diversified away. Okay. So the other way of thinking about this is that if you have got higher values of beta, you should think of those as basically more like stocks. And if you have got a lower value of beta, you should think of that as for example, like a debt, right? So for example, if you have got beta equal to 0, that would be the case where you have got expectation of RI equal to RF, right? So in that case, the asset does not actually have any basically any correlation with the stock market movements, and so it's risk free in that sense, right? So the expected rate of return would be RF. But as the absolute value of this beta I goes up, this you can expect that this expectation of RI will start deviating from this RF, right? Okay, so that's one finding. Let's look at some practice problems also. So suppose that the risk-free rate is 3% and the expected rate of return on the market is 8%, right? So if we now plug in these numbers in the CAPM formula, which is this formula that we had here, what we can see is that RF is 3%, expectation of RM is 8%, and RF is 3%. So the equity premium is 8% minus 3% or 5%. So expectation of RI is 3% plus 5% times beta I, right? So as the value of beta I keeps on changing, the expected rate of return would also change, right? So a project which has a beta of 0.5, for example, would have expected the cost of capital, which is this expectation of RI, would be actually given by so this should be half into 5% plus 3%. Okay. So this is a typo here, which we will correct. And if you have a beta of 2, so that will be 2 into 5% or 10% plus 3%, 13%, right? So here, if you have 3, this should be actually 5.5%. So this we will correct later. Okay, the CAPM represents the opportunity cost from the investor's capital. So, for example, if you have got a project with a beta of 0.5 and it cannot earn expected return of 5.5%, not 4%, then one should not take up this project, right? So that's how you can kind of like link it to the capital budgeting decisions that we have discussed so far, right? We'll also come back to this later on, as you will see. Okay, we can use the CAPM formula and think about it graphically as well. So this one where we have got the expected rate of return plotted against beta I. If we do that, then the CAPM formula can be actually thought of the relationship linking these two variables. And if we do that plotting, then we get what is called the security market line, right? And so this is the line that you have here when you have got the expected rate of return on the y-axis and the project beta on the x-axis, right? And you can see various points here that you could expect, right? So for example, if you have got beta equal to 0, then the expected rate of return would be 3%, right? So this is the number that you see here. And of course, if beta equal to 1, then this RS would cancel out, and then the expected rate of return would be the expected rate of return of the market portfolio, which is this 8% that you see here, right? Now, one thing to note is that the intercept is the risk-free term, but here you might think that the intercept seems to be something negative. What is going on? Well, because we have not drawn the intercept at 0, right? If you had drawn the intercept, the y-axis at 0, then you would have got, in fact, 3%, right? So here, just because we want to show what happens if you have got negative beta, we have gone to this side as well. Okay, so as we mentioned that remember the initial motivation for our whole discussion so far is that we want to find out an expression for this expectation of R1 or expectation of R2 in the denominator, and CAPM actually helps us to do that, right? So one implication of whatever we have been discussing is that if you have got cash flows that correlate more with the overall market, they're going to be of less value to investors, right? Why is that the case? Because then beta is going to be higher, right? And that's therefore going to be of less value in the sense that it adds to the market portfolio's risk. And so therefore the expected rate of return is going to be demanded by investors are going to be higher. And what that means from NPV is that then they also require kind of like higher cash flows and higher expected values in order for this project to be actually implemented, right? Because if the denominator is higher, then all of these things are going to be dragged down. And so therefore you need some other compensating things to actually go up in order for this NPV to be positive, which is the condition for the project to be taken up, right? Okay. Now, one thing that might have puzzled you a bit more is that if you think about the full form of this CAPM, this was the capital asset pricing model, right? But so far, our discussion has been in terms of rate of return, right? So, where is the pricing aspect in this CAPM model? Well, there's another version of the CAPM that we are going to look at now, which actually gives you a formula for price of the project or the asset as well, right? So let's see how that works. So suppose that we have got a formula. Um, so an asset which is purchased at price P and sold at price Q, right? Now we know that if that is the case, then the rate of return which is associated with this asset is going to be just Q minus P by P. So this is going back to our initial lessons of what is the definition of rate of return, right? Now, when you're buying the asset, you know what P is, right? Because this is the price that you can just go out and see now. What you do not know is what is this Q, right? So this Q is something that's going to be realized sometime later in the future. And so from today's perspective, this is something that is random, right? So therefore, we can think about what's the expected value of Q and so on. Now, CAPM, remember, is a formula which links the expected rate of return to several things. So here the expected rate of return is going to be expectation of Q minus P divided by P. And CAPM says that that expected rate of return is going to be given by the risk-free rate plus beta times expected rate of return on the market portfolio minus the risk-free rate. And so therefore, now we can actually simplify the left-hand side. So if we do the simplification, this means expectation of Q divided by P minus 1. And if you take the 1 to the right-hand side and then solve for P, you end up getting an expression for P, right? So what was P? Remember, P was this price P, right? So CAPM also gives you a formula for what the price of a particular asset should be today, right? So this should be equal to, in this case, equal to expectation of Q divided by 1 plus RF plus beta times expectation RM minus RF. So this formula, which we have just kind of like derived from the standard formula that we have seen, just using the definition of rate of return. So this is known as the pricing form of the CAPM. We'll see later on a practice problem which is related to this pricing form as well. Okay, so let's think about some other worked examples. So suppose that you have got a risk-free rate of 4% and the equity premium is 5%. You have got a project which is worth of 100 units and has an asset beta of 2, and it can be financed using 20 units of risk-free debt. So what is the equity beta for this project? Now, what is the connection of equity to all of the information that is given? Well, the project is kind of like value is 100 units and risk-free debt is 20 units, right? So that means that equity is the remaining 80 units. Now, we do know a relationship between the beta of the overall project with the beta of equity and debt, right? Remember this formula that we have seen, which is that beta of the firm is the weighted average of beta of debt and equity, where the weights are respectively the debt value by firm value and equity value by firm value, right? So let's think about what are the information that is given to us. It's a 100-unit project. Uh, you have got 20 units of debt. So therefore, debt value by firm value is 20 by 100, right? Or 1 by 5. And equity value, therefore, is 80. So that's 100 minus the debt value. And so therefore, equity value by firm value is 80 by 100, right? Now, you're told that what is the beta firm or the beta of the asset. So that's 2. Uh, you're not given beta of debt, but you are told that debt is risk free, right? So if debt is risk free, that tells you that basically the covariance of this rate of return of the debt and the rate of return of the market is 0, and so therefore beta is 0, right? So if it is risk free, then beta debt is equal to 0. So you can plug that in, and therefore if you do the calculations, you end up now, therefore the only thing that you don't know is exactly what you're asked to solve, which is what is the beta of this equity, right? So if you do the solve here, so this part becomes 0. This is 4 by 5, so 2 into 5 by 4. So that's 10 by 4 or 2.5, right? So beta equity is equal to 2.5. That's how you get the answer here. Okay, so again, something that we had mentioned before, that typically this is the market beta of equities that are actually reported on financial websites, right? So one thing to kind of like be careful when you're thinking about what should be the expected rate of return or the cost of capital for a particular project, when you are thinking about it, you should actually use the asset beta, not the equity beta, right? So here, for example, if you had used the equity beta, so this 2.5 number, then based on these things, we would have come up with that the expected rate of return should be 2.5 into 5 plus 4%, right? That's what the CAPM formula is. But that would be an incorrect application because the expected rate of return would not be 16.5% here, right? What you should think about when you're thinking about from the project's perspective, the expected rate of return is the asset is the one that is calculated on the basis of asset beta and not equity beta. So asset beta was 2, and so therefore 2 into 5% is 10% plus 4% is 14%. And so the for the correct value of expected return should be 14%, which you should use as an input in the NPV formula if required, right? Okay, let's continue with this example. Suppose now basically you still have the same things, that the risk-free rate is 4% and the equity premium is 5%. But now suppose that there is a firm's project whose cost of capital Rita would like to estimate. So the only things that you know is the risk-free rate and the equity premium. Rita observes that a comparable project is being undertaken by a similarly sized firm, and so thinks about, okay, on the basis of that observation, can we come up with a measure of this cost of capital, right? So she looks up what is the financial website listing as the firm's beta, and she sees that the financial website uses a beta of 2 for the firm, right? So can she use this beta of 2 to come up with a cost of capital? Well, the first thing that Rita should be careful of is that financial websites again typically list equity betas, right? So she would not actually kind of like necessarily directly use this 2, right? But she can use it as an input in the analysis. So if suppose that this is indeed the equity beta, we need to come up with a way of calculating the asset beta, right? Which is the again the relevant thing to use as an input when you're doing the calculation. So Rita, when she's looking at this comparable firm, she also needs to figure out how is this firm being financed, right? Remember, she would wants to figure out what is the beta asset of the firm. She has information on what is the beta equity, right? So she needs to look at the composition of this firm in terms of debt and equity. And suppose Rita finds that it is financed by 80% debt and 20% equity, right? Then the next thing to look up is, okay, is this debt risk-free or not? If it is risk-free, then you can use the risk-free calculation. So the beta of debt would have been 0. But if it is not risk-free, then one needs to actually kind of like adjust for that as well, right? So then the next step for Rita should be to look up the rating of this company's debt. And suppose that she finds that this company is rated only A, right? Remember, A is a good rating, but of course, the highest possible rating was AAA. So it's not the best rating, right? So it's risky in some sense. And then therefore, now you have to think about, okay, what would be the rate of return that you would associate with a debt of this class? And suppose that you find that it's 5%, right? Okay. Now we are almost in a position to calculate the expected rate of return for the project. Remember, this is a weighted average of the rate of return of debt and equity, where the weights are basically given in these proportions. So 80% debt and 20% equity. So the weight would be zero point 0.8 for the debt part and zero point 0.2 for the equity. Rita knows what's the expected rate of return on the debt for debt which is rated A. So this is the 5%, right? Uh, so by the way, this should be actually again 0.05. And she also needs to look at what's the expected rate of return for the equity, right? So how would she calculate that? Well, she has basically several inputs, right? She knows that this is 2, and she knows that the risk-free rate is 4% and the risk premium is 5%, right? So beta into equity premium is 10% plus 4%, so 14%, right? So this should actually be zero point 0.2 into 0.14 plus zero point 0.8 into 0.05. And from there, one can go ahead and do the calculation for the expected return of the project. Okay, let's look at one more problem. So suppose that you have got a firm G, which is worth 900 units, and it has a beta of 2 and a standard deviation of 20%. And it merges with a firm H, which is worth 100 units with a beta of 1 and a standard deviation of 20%, right? Suppose the risk-free rate is 3% and the equity premium is 5%. So what would be the expected rate of return of this firm and the beta of the firm if this firm G and H merge, right? So we are thinking of a situation when you have got information about individual firms and they are merging. Then can we find out what is the combined rate of return and the beta of the combined firm? So again, we can use whatever we have studied so far. So the expected rate of return of the combined firm is, let's call that firm GH, is going to be given by the weighted average of the rate of return of G and H, right? Where the weights are basically their values. Now, the relative values are easy to find. So firm G was 900, firm H was 100. So the weight on firm G should be 0.9 and weight on firm H should be 0.1. But what about this expectation of RG and expectation of RH? Well, in order to calculate those, that is where we require this some of these information, right? So expectation of RG, so using again the CAPM formula, is the risk-free rate, so 3% plus beta. So this was 2 times the risk premium, right? So 5%. So you have got this is 10% plus 3%, so 13%. What about the expected return on firm H? Well, you can use the CAPM formula. So 3% plus beta was 1, right? And then again 5%. So you end up getting 8%. And what's the expected return of the combined firm? Well, now we have all the pieces of information. So zero point 0.9 times 13% plus 0.1 times 8%. And if you do the calculation, that's 12.5%. The other thing that you were asked to calculate was what is the beta of the combined firm, right? So we know that beta of the combined firm is again the weighted average of the beta of these individual components. So we have the weights, we have the betas, so we can do the calculation and show that it's equal to 1.19%. So notice that once you have got this combined firm, this also will actually follow the CAPM, right? So the way to see it is that suppose we want to calculate this expected rate of return using CAPM formula and not in the way that we have done here, right? So what would be the implication? So you have got the risk-free rate, that's 3%. The beta that you have computed, that's 1.9 times the equity premium, which is this 5%. And now if you do the calculation, so this is again 12.5%, which is exactly the number that you have found here, right? So these are different ways in which some of the formulas that we have seen can kind of like be applied. And there are some insights that you get about, what are the benefits of diversification and when does it apply and when does it not apply, right? So in this merger example, for example, you can think about, okay, what are the implications of combining these two different things in terms of expected rates of return and the risk in terms of beta and so on, right?